From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, December 17th, 2021, and you're listening to the HPS Macrocast. I'm Megan Pennington with John Fagan and Brendan Walsh from Markets Policy Partners. Hi, guys. It's so nice to be back. It's been a while since I've seen you.
It's great to have you back. Your triumphant return to the Macrocast. We're delighted.
My triumphant return for the Macrocast, just in time for the end of the year. I'm like eking one in before your end of year episode.
Yes, and although we're still virtual, you're back in the podcast studio where we hope to be in 2022.
Gosh, the podcast studio is, for me, one of the things that I remember most vividly from the first days of COVID, because of course it was a Thursday night that we closed up and went remote early in March 2020, but we had a podcast scheduled for Friday, and we had no idea what was to come. And of course that was our last one in 20. That last Friday podcast in March was we didn't even see this room for months and months. So it's nice to see you again.
Yeah, some of the soundproofing tiles have fallen off the wall. Yeah, there's some little cleanup to do. But anyway.
Yes, Never mind. Well, it's so nice to be back with you all, and we've had an enormous central bank week. I think even some have said central Bankapalooza. So let's talk about it. Let's get right in. What's been going on?
So on the Fed front, it was pretty well telegraphed. Even starting back in November, a lot of Fed speakers had kind of turned a little more hawkish, saying that at a minimum we should be reducing the size of our balance sheet at a faster. Well, they hadn't begun it yet, but they said we should start reducing it. And then actually at the Humphrey Hawkins testimony, which normally as a Fed official you try to say nothing, but Powell actually used that as a chance to kind of was described as a hawkish shift, and where he started for the first time saying that yes, the labor economy is doing well. The inflation that we thought was going to be transitory might not be quite as transitory as we thought, so let's not use that term anymore. The market started pricing in that the Fed would reduce their balance sheet at a faster pace than they had originally planned, and B, maybe we would get some rate hikes in 2022 quicker than they had originally priced in. And that's pretty much exactly what happened at the Fed meeting. And it's called the dot plot, but all it is each Fed president puts a dot on a map and a chart saying where they think the rate should be. And basically, we went to have three rate hikes in 2022, which hadn't previously been priced in. And kind of amazingly, I think because it was fairly well telegraphed, the market took it okay, because at a minimum now the market had a path that it could digest. So that was on Wednesday. But then Thursday, we had central bank meetings from Bank of England, Bank of Mexico, Bank of Turkey, which is a little bit of an outlier. We can talk about that later. Big outlier. And the ECB. So so the market confidence in that it's okay, rates are going up, was a little shaken yesterday. I'll let John talk, especially about the Bank of England.
Yeah, the Bank of England surprised with a rate hike. This is after it swerves back and forth in the communications that has whipsawed financial markets and the UK rates markets in particular about where the Bank of England was on the subject of inflation fighting, and so they went from no rate hikes this year to priced in 100% rate hike in the November meeting. They didn't hike rates in the November meeting. They started talking down the potential for rate hikes in the December meeting, and Omicron was coming in and sweeping the UK. We've seen the dismal data there, and the shutdowns and that sort of thing coming back to the UK. And the Bank of England what do you know? They came out yesterday and hiked rates. And when it certainly wasn't necessarily the strong consensus that they would do so. It was a very close decision.
Yeah, and the market reaction to the Fed might have kind of pushed a few of the voters over the edge to say, okay, let's do it. Market's okay with higher rates.
Yeah, and the Bank of Mexico was the encore act. They hiked more aggressively than expected, and then the European Central Bank announced that they were going to cease their pandemic emergency purchase program, the PEP program, which is a subset of their quantitative easing, or an addition to their regular quantitative easing asset purchase programs. They announced that would be ceasing in March of 2022 as scheduled, although they tried to cushion the announcement with a moderate increase in the regular ongoing underlying asset purchase program to help smooth the transition. This was again kind of expected, but certainly not as dovish as the European Central Bank could have been. They certainly could have, and would have had public health justification, I suppose, to extend the pandemic emergency purchase program, because it sure looks like the pandemic emergency keeps extending itself, and Europe is obviously more able to, or more willing to do the kind of draconian restrictions, travel restrictions, and so forth that don't play necessarily politically well in the U.S. anymore.
Well, so I want to ask about that. I want to talk to you all about how the markets reacted, and you mentioned a little, but I wonder what happens. Like, we're just seeing Omicron take off. I mean, New York last weekend, it seems like everybody was, we've kind of moved into this world where we think we put the pandemic behind us, and then Omicron is coming for us, and cases are crazy, and we're shutting down businesses again and seeing some. And I think, if in the next couple of weeks, it will be telling in other cities, at least across the US and then around the world, how is the Omicron variant going to impact behavior and spending and, consumer behavior, especially around the holidays. So I wonder, is there, can we see a reversal of any of the, is it going to make people nervous about?
Well, at the risk of oversimplification, global central banks back in September, October were saying, we are going to stay easy for longer because of the Delta wave. Flash forward to now, they're saying we're going to hasten our withdrawal of accommodation because of the supply chain impacts that we expect from Omicron. And so in the, just a few months ago, global central banks were very focused on the growth impact, the potential growth impact of the ongoing Delta wave, or at least the Delta wave that was sort of crested and playing out. But now the focus is on the inflationary impact of this ongoing public health crisis. And so when you have a situation where the Fed is seems to be directing its tightening policy into what is essentially another supply shock, in order to try to attack those second round effects like expectations and the knock-on effects of inflation. And yes, the labor market is tight, but we'll get into that. We'll get into that in another segment here. But the Fed it's a real big paradigm shift of global central banks, and the question is, these are still supply shock driven aspects. There's obviously, strong demand, and people have shifted demand to goods because services they're less able to consume or feel less comfortable consuming. We've talked about this a number of different times, of the kinds of dynamics that have created this. But the real difference here is how central banks are orienting themselves toward it. And when you look at financial markets, if you look at headlines, you say, oh my gosh, there's an inflation panic. If you look at financial markets, they look awfully disinflationary, at least the trends that we're seeing. It's reflation in reverse. Oil prices are down 20% off their highs. We're seeing the TIPS break-evens, which are the inflation, the inflation break evens, essentially the market-based gauges of inflation expectations coming off. The 10 years at 2.4%. That's like aligned with the Fed's policy goal, and has totally nothing to do with where headline CPI is. It's where market expectations for long run expectations are. When you see what's coming out of, there's a lot of air coming out of the tech stocks, some of the most pumped up, fluffed up tech stocks that had benefited from a permissive liquidity environment and expectations of low rates as far as the eye can see, are now having to readjust to this new reality. And I think the question really is, can global central banks actually attack real world inflation without that effort being swamped by a deflationary or disinflationary freakout in global financial markets, which would come first?
And I wonder, do you think, the conversation on inflation has skyrocketed over the past few weeks? Though last week, I think you all had a conversation about the CPI numbers and talked about how the numbers aren't showing that it's really a big problem. There's, maybe a little bit is, we were due for a little bit of inflation, but it doesn't seem like it is this thing. I mean, from public conversation, it is everywhere. It is, the price of milk, the price of, how your gifts, they're going to, supply chains out of whack. But I wonder if maybe this move by the central bank, or if there's some human psychology element of it, almost of, having to respond to a changing sentiment from people around the world about what are our biggest macroeconomic problems.
It's a really good point, because inflation's so weird, because I don't think anybody, even in the low inflation environment that we've had for the past decade, I don't think people would have said that low prices are a problem. That was like the realm of central bankers. The way that the individuals experience inflation has very little to do with what headline CPI looks like on kind of a day-to-day basis. But the most obvious ways in which it's hitting consumers in the pocketbook and the wallet and so forth right now really is, gasoline and food prices. Those are just very salient. They're obviously amplified.
And that's where the politics comes from. Exactly.
Yeah, and they're amplified by politics. It's a really good point.
But interesting. Inflation is a hard thing to measure. Like the cost of milk is easy. It's either up or down, and you see it in your pocketbook, and that does affect a huge amount of people. But like the cost of a new car, that is up because of semiconductor shortages. So say it's up 5-10%. But if you watch any commercial, you can buy a new car with zero down, zero financing costs, and not have to make a payment for 3 years. So our borrowing costs are so low because the world is so flush.
You can really buy a car that way?
Yeah, any car you want. If you take out a loan against it, and you really don't have to start paying for years. It's subsidized by the auto industry. So even though the cost of that car might have gone up 10% from last year, the cost for you in your pocketbook has actually gone down, because you can have it for 3 years without even making a payment. Same with mortgage prices. While the housing prices of going up, the cost to borrow that is going down. So it's just part of it's the hard part of how we measure inflation.
Mm-hmm.
And the other part is one of the other sort of unspoken things about inflation is Fed policy and very the quantitative easing, asset purchases, ballooning the balance sheet, super low interest rates. Those are known to generate inflation. They're known to generate asset price inflation, home prices, stock prices, and so forth, commodities prices too. And so when you have that, those are obviously, some of the biggest areas of so-called inflation, if you want to really expand the terminology, like some people do. And that's the issue really is, if the Fed is concerned about CPI, and CPI is driven by higher fertilizer prices and used car prices, the Fed tightening policy is a very roundabout way to try to address, if the Fed is trying to address those, they're gonna have a lot of disinflationary pressures in the markets.
Exactly.
Long before they affect phosphate prices.
Right. And that's the part. The Fed knows how to fight inflation. They raise rates, which raises the cost of borrowing, which slows the economy, which thus slows inflation. I suppose we say, well, we have to fight inflation, but the way you fight inflation is by increasing the unemployment rate and slowing the economy.
Mm-hmm.
I'm not saying we shouldn't do it, but that's the part of the discussion that no one says. We just say we have to fight inflation. Well, here's how we do it. Do you want that? Going back to the political aspect.
Yeah, and you can certainly do some scenario analysis and planning ahead. You know, the idea that, gee, if global financial markets really don't like this big paradigm shift to fighting inflation at a time when Omicron is coming through, and you do have a disinflationary or reflation in reverse dynamic going into the first quarter of 2022. You know, what if CPI is still high? You know, what's the Fed going to say if oil prices are like going from like into the 70s, 60s, 50s? If you see,
which what the EIA and OPEC just said to you, that we're in the oil market is now in oversupply situation, and it's only going to get worse.
Yeah, and you can see a situation in which, you know, global coordinated monetary tightening or withdrawal of accommodation knocks the NASDAQ, you know, and tech stocks 15-20% off the highs. You know, is the Fed still going to be in its inflation fighting mode, even if CPI is really high? You know, the way that they target, you know, financial conditions, a big component of financial conditions is stock prices. And so we've seen in the past, and we saw the Powell Fed do this in early 2019 after they had executed their last rate hike in that cycle, which the markets had real problems digesting. You know, the growth wasn't really slowing, but the Fed was pivoting toward loosening because of tighter financial conditions. And a lot of that was asset prices in reverse. And so, you know, the Powell Fed has been here before. We think that they've seen, you know, this kind of the way in which markets can amplify the moves in the real economy, get way ahead of the game, and put pressure on the Fed. And so this is a tricky moment for the Fed and global financial markets in the dialogue between them.
Well, so it's just about to add.
Yeah, and they made this decision literally a week before Omicron is sweeping America. Dr. Gottlieb said, you know, I think in the next 5 days, you're going to see a lot of stuff shut down, and you should probably plan to cancel things for the next month.
Yeah, and that
was not on their playbook.
Right.
Oh,
yeah, I mean, we
literally
were kind
on
of
Wednesday,
thinking
it wasn't on their playbook. Yeah.
We were kind of thinking going into this that they might, you know, give a little less in terms of rate hikes or a little less in terms of the sort of hawkish vibes than the market was expecting, because this is an environment where you really don't want to oversteer. You want to look at the Bank of England and say, gee, what not to do, right? don't oversteer into these twists and turns. Kind of set your course and, you know, balance the risks and don't overcommit. And the Powell Fed overcommitted to its tightening cycle in fourth quarter of 2018 and paid the price with credibility by having to do a big pirouette. And the Bank of England has done the opposite of covering themselves in glory here over the past few weeks. And I'm not saying it's easy, but it's a challenging moment for central banks to kind of set the line and try to strike that balance.
And
it's
really
hard.
Christine Lagarde at the ECB has probably done the best job of having full control over her committee and basically saying, okay, this is what we're going to do. And I think we should remain a little more dovish.
Yeah, I mean, you can disagree with how dovish, you know, you can say, well, the ECB's been more dovish than they need to be or less dovish than they need to be. There's certainly room to disagree on that front. But I think I think you hit the nail on the head, Brendan, by saying that they have been very, very steady in their messaging. And they've really held a very, you know, a pretty straight and predictable line in their policy making, and that's not necessarily an ECB hallmark. So, President Lagarde is pretty firm hand on the tiller, it seems, these days.
Cool. Well, that's great. Okay, let's take a break. And when we come back, we'll discuss Build Back Better, which is on everyone's minds in just a minute.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter at marketspolicy.
And we're back with the HPS Macrocast. I'm Megan Pennington from Hamilton Place Strategies. I'm here with John and Brendan from Markets Policy Partners. All right, guys. So we're ticking down the last minutes until Congress packs up for the year, and we still don't know the fate of Build Back Better. And I am. I think anything is possible. After spending years in the Senate, where we, go all the way up to a deadline, even though we don't have a real deadline here. You never know. There's always magic possible in the last minutes and last hours as we lead up to a break. So, I don't ever want to say that, that nothing is written in stone yet. I think there's this idea that negotiations are still happening, though I will say it's looking bleak. It's difficult to imagine a world where Democrats in the Senate can find consensus and move forward. But again, I guess anything is possible. So, as you guys are watching the news, what are you thinking?
Yeah, it's in terms of the market impact, the bipartisan infrastructure bill is a more direct market impact because you can pick out the stocks, the very specific stocks that this will feed directly into. It's maybe a little less clear with the social infrastructure, obviously sort of green initiatives. You do have the sort of solar and those kind of stocks, but it's less of a market mover on an individual sort of or a sectoral basis or big sectoral basis, I guess. When thinking about it, it's sort of more taken by in the financial and sort of macro community as more of a story about the impact of fiscal spending and in general. And this kind of social spending, is it inflationary? That's certainly the GOP talking point. It's something that Senator Manchin has hammered on in his basically in crafting his case and pushback against the bill. That it's just more dollars going into the system, and in a time when inflation is already, in multi-decade highs and so forth. The counterexample, Treasury Secretary Yellen has put this forward pretty forcefully, along with other Biden administration officials, which is this is disinflationary for a variety of reasons. It attacks the kinds of price increases that really are felt most acutely by Americans, and it's healthcare prices, it's child care, elderly care. These are costs, real costs on the Americans' household balance sheet that aren't necessarily reflected in sort of the traditional CPI basket, and also the point that Secretary Yellen has made is, these are designed to help people get back into the workforce, and you get more affordable childcare. And that's been one of the major dynamics that we've seen in the pandemic: women out of the workforce and potentially not returning because of the expenses of childcare and the risks around childcare these days, I guess. And so it's sort of point counterpoint. Financial markets aren't necessarily responding to it. And certainly you don't see a lot of, as we mentioned in the previous segment, you don't see a lot of inflation panic or a virulent reaction to the Build Back Better can kick here. But, it's sort of part of a larger narrative.
So I want to push on your point on inflation a little bit. Senator Manchin is saying that a lot. Like, Senator Manchin is concerned about spending so much money. He's concerned about inflation. He has said that. He's been a moving target. I think it's been difficult for anybody to predict where he will ultimately fall on what could be in a social spending bill like Build Back Better. But I wonder, to the points that you just made, so much of what's in there are things that are, at least according to the Biden administration, designed to lighten the burden of many people who feel like they, or not, I don't feel isn't the right word, but who are struggling to afford childcare, just like you say, struggling to afford elder care. They are not able to participate fully in the economy like they would like to. And these investments would shore up systems. I mean, again, according to the Biden administration, these are investments that would make it so that, we are on a better path toward economic growth and prosperity in the long term. People are better able to fully participate in the workforce if they have access to affordable and high quality childcare. So I wonder, are we failing? And I just mean the public broadly, or is Congress or, the people we're supposed to listen to, are we failing to explain how inflation really works? Should there be more talk of what investments like this would really do to growth? It feels like, we talked a little bit about this in the last segment, but it's difficult to understand inflation. So I think by the flip side of that, it's difficult to understand how federal investments actually impact, the everyday lives of people, unless it's a direct check to them. So I just wonder, are we all kind of misunderstanding some of the equation here?
Oh, it's just such a harder point to make that is, over time, over a long term, this will be, all else being equal, disinflationary. That's just so much harder to make than, grabbing a megaphone and saying, look at your milk prices. There's no way that one is gonna overbalance the other with the American public and or really any sort of group of human beings. The immediacy of inflation makes it a really strong talking point, and the kind of, let's face it, kind of wonky discussions about exactly how inflation is felt and how over the long term, the Biden social spending plans can ameliorate it, that sort of thing is, it's too wonky to fit on a bumper sticker, too wonky to make it into the sort of broad consciousness, I think. And that's just a natural way our brains work.
I mean, I have always thought that Democrats, and I can say this because I work for Democrats, I feel like Democrats failed to figure out a succinct way to explain that when they want to do something, like when Democrats were trying to pass the Affordable Care Act, something, by the way, that we ultimately did like on Christmas Eve. I remember because it was snowing a little bit that day, and my current boss, Barbara Mikulski, was driving in from Baltimore, and it was a little bit crazy. But we struggled in that debate to talk about, this is about a structural change to our economy and to our healthcare system, so that in the long term, healthcare we will throttle healthcare costs and expand care. But that's a really hard thing to explain, because the idea is, well, but right now there's going to be some volatility and uncertainty, and your prices are. I mean, the truth was that it was volatile, and some people's healthcare prices did skyrocket, and others had different plans, and so. Now, as we look at this big domestic spending plan, I wonder if Democrats haven't failed a little bit to come up with the succinct rebuttal to the inflation argument that explains, wait a second, you can't just throw the inflation point into the mix without thinking about what the long-term impacts are. Again, I think it's hard.
Well, does it really matter whether they explain it to the public? Or they really just have to explain it to one person?
That's true.
Senator Manchin's worried about $2 trillion being added to the deficit. It's not. It's over the course of 10 years. So you're adding $200 billion a year or so, because this can't be spent. You're not going to print $2 trillion right away. We'll add about the deficit will be about 60 trillion in 10 years. So adding 2 trillion to that 60 trillion is not a big number. So his concern about 2 trillion inflation is really, in my opinion, from an economic standpoint, misplaced.
Well, I would never be so foolish as to venture a guess into what goes into the calculus in Senator Manchin's positioning on the Build Back Better Act. But I don't know. I think he's trying to figure out where does he sit. I think he takes this responsibility of being a moderate in the Democratic Party in the Senate very seriously, and he thinks that he's this bridge between the poles of each party, and how can he try to like find the middle ground. But yeah, when you make the argument that way, Brendan, it seems like, okay, well, really, are we worried about the $60 trillion in 10 years? What's two more? Over 10.
Yeah. I mean, the Democrats, the point you made, Megan, about the Democrats not being able to sell their policies. I mean, that has been a knock on them for a really long time. Things tend to be wonky and very tethered to a truthful sort of, professorial explanation of exactly, let's sit down here and work it out on the whiteboard.
Yes.
We're coming off of 4 years of the salesman in chief, who wasn't tethered necessarily to a strictly factual assessment of the policy, but he knew how to sell it, right, to his base. He knew how to sell it to his supporters in a very succinct and compelling way. The Democrats do not play that game nearly as well or in the same way, I guess you'd say. But one of the things that we might see, what we will see differently, I think, is it's easy to kind of take the bipartisan infrastructure bill and say, okay, it's done, it's dusted, and now it's just going to be running off into the in the background. And I think that there's really something there in terms that there's so much work to be done in terms of actually getting execution and getting these projects going. And I think that that's where the Democrats may be able to find, to make up some ground in terms of selling this. They're going to have to do some, they're going to have to do some major projects to make sure that this thing is understood to be doing what it's supposed to do, which is create jobs and upgrade American infrastructure. And that's something that is a really saleable prospect. And to the extent that they can start executing on this in any sort of timely way with the projects, or showing that there's projects and progress being made, I think that that's something that they really need to hammer on, and doesn't necessarily have the same. It's like, Biden in a hard hat out at the bridge. That's easier for Democrats to do than to explain the policies in the sort of, supply demand charts and that sort of stuff like they usually do.
It seems to me that Senator Manchin is less concerned about inflation and less concerned about the sanctity of the Senate when it comes to the voting rights, and more concerned about reporters not following him around all day.
He does seem to like the attention.
You bring up voting rights. I have the question for you, Megan. Senate Majority Leader Schumer has pivoted toward that. He's going to try to get something going on that front, some momentum going before the holidays. Drum roll, please. What's your call? Is this just is this just a lost cause at this point?
Okay, so I do think that Senator Manchin is open to doing something on voting rights. And as we just acknowledged, he's the guy right now, just because of the 50-50 breakdown. Do I think that it can happen before the end of the year? I don't know, but this is actually, this is actually a really interesting thing, because I think if you look at BBB and voting rights, I am in the camp that BBB, it's going to be really difficult if we go into next year. We don't do things if there's not a deadline, and there isn't a real deadline, but Christmas is always a thing. It's like, what are we going to do before we go home? Voting rights, however, has been such a scary, I think there are people who are deeply, deeply concerned about Americans' access to the ballot box. And that cuts across party lines, though everybody has their own external public remarks and what they'll say on that. But I think that Joe Manchin is in that camp of being concerned and is bought in on, we have to do something about voting rights. And so I think that it's possible for something to move. I don't think it'll happen this year. I think it'll probably have to be next year, but I think there's a good chance. But what does that leave in the balance for 2021 and what we can finish in Washington before the end of the year? I don't know. It's really interesting that we've seen this pivot to voting rights. My read on that, as an outsider, I have I don't have any special information, but just me watching and knowing those personalities, I think it's Schumer reminding Senator Manchin, this is something that you care about and it's important, and we still have we have important legislating to do, and like maybe let's focus on this for a second and focus conversation on this, where you're more open to doing something in principle, because that's the big thing. It's something in principle, and it's not there aren't those same economic arguments where we know that Senator Manchin gets very conservative very quickly. So I don't know. That's my forecast on that, I guess, which is very wishy-washy. I didn't make any real predictions, just a few hunches around the edges.
Well, predictions are always difficult, particularly about the future, as they say. Speaking of the future, what do we have next week on the calendar, Brendan?
Next week is the week that we get the personal income and spending, but within that report, we get the Fed's preferred measurement of inflation, the PCE price index. Other than that, it's relatively quiet week.
Well, quiet heading into the holidays, and those are like the famous last words.
Right, exactly. Well, on the data front, I mean, it might be a busy week on every other front, but there's not a ton of data. We brought forward a few of the things to make sure we got it in before the holiday ended.
Got it. Good. Well, listen, thank you guys so much for having me back. It's so nice to be together.
So great to have you back.
It's so nice to be back with the crew. And thanks everyone for listening. You've tuned in here to the HPS Macrocast. We will see you again next week. I'm Megan Pennington with Hamilton Police Strategies, and thanks so much to John Fagan and Brendan Walsh with Markets Policy Partners. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.